All right, everybody. Welcome back to Strongman Personal Finance. Today, I'm going to show you some mutual funds that you can invest in with no investment minimums. So you can start investing with just $1. Let's go. All right, so before we get into these mutual funds, I want to go over the golden rules of mutual fund investing. Number one, you don't want to pay any sales charges. I talked about this in a previous video. That's when you pay somebody up to 6% of your initial investment just for the privilege of investing in the mutual fund. You don't want to do that. Number two, you want to find mutual funds with low expense ratios. An expense ratio basically tells you how much of the mutual fund is going to cost you every single year. Finally, you want to go with indexed mutual funds. A lot of people say you can do actively managed mutual funds, but indexed mutual funds are superior, and I'm going to show you why. All right, now I can't reiterate this enough. You don't need to pay sales charges to start investing, all right? There's plenty of sales charges out there, and they're basically a ripoff. For example, a front end load. What that means is that if you invest in a mutual fund, you're immediately going to pay a certain percentage of your investment to a sales commission. Same thing with the back end sales load. If you sell your mutual fund, you're going to pay a fee. You're going to pay a sales charge to probably your financial advisor or whoever you're investing with. You don't want to do that. There's hundreds of mutual funds out there that don't charge any sales charges. Those are the ones you want to go with so you don't start losing money right off the bat or when you sell your mutual fund. All right. So you have front end, back end sales loads. Usually they're about 5.75%. And then you have 12B1 fees. 12B1 fees are basically recurring sales and marketing charges that compensate your financial advisor for putting you in the mutual fund in the first place. If you pick your own mutual fund, you don't have to worry about paying these. Don't pay them. Now, when you're shopping for a mutual fund, you want to look at the expense ratio. All that means is how much money you're going to be paying every year to the management to invest your money for you. All right? You have to compensate the management. They're not doing this for free. So, for example, if you have an expense ratio on your mutual fund that is 1%, if you invest $100, that means every year you're paying $1 to the management fee. All right? A lot of mutual funds charge around 1%, some charge a little bit more, and there's a lot of mutual funds that charge a lot less. Those are typically index funds because they don't require a lot of management attention. When you're buying mutual funds, you want to buy mutual funds that track an index. An index is something like the Dow Jones Industrial Average, the S&P 500, the Nasdaq, the Treasury Bond Index. Basically, for every asset class, there's an index that tracks that asset class, all right? Index funds are superior, number one, because they are low cost. The management of that fund doesn't have to do a lot of work. All they're doing is trying to match the performance of the index. So for example, if they're tracking the S&P 500, well, they can just buy all the stocks in the S&P 500 to track it as closely as possible. It doesn't cost that much to do that. So number one, they're cheap. They don't cost that much to run. Number two, they generally outperform actively managed mutual funds. Look at this picture here. All right, this is a percentage of large cap funds that underperformed the S&P 500. They did worse than the S&P 500. And these are guys that are trying to beat the S&P 500. So in 1 year, 64% of actively managed mutual funds did not do as well as the S&P 500 index, right? And if you look, the longer the time period, the more these guys underperform. So these active mutual fund managers, yeah, they may do good 1 or 2 years, but in the long run, they severely underperform indexed mutual funds. So if you invest with actively managed mutual funds, you're generally paying a higher expense ratio and you're gonna underperform index funds themselves. So it's a better bet in the long run to get indexed mutual funds. Please do it. So here's my first example of an index mutual fund. This is the Fidelity 500 Index Fund. I will put a link in the description of this video so you can go check this out yourself when you're done, all right? The reason I like this is because number one, there's no minimum to invest. So if you have $1, you can start investing in this mutual fund. I mean, you should probably put in more, but with $1, you could start. Also, it's extremely cheap when it comes to the expense ratio. If you look at it, it's right there on the screen on the left side. The expense ratio is 0.015%. What that means is that for every $100 you have invested, you're only paying about 2 cents in management fees a year. That is dirt cheap. That's basically free. Now, when you buy this mutual fund, you're buying a tiny piece of 500 of some of the largest companies in the United States of America, all right? If you look on the right side, you can see some of these companies. You got Microsoft, Apple, Amazon, Facebook, yada, 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 yada. These are all huge companies that I hope you recognize, all right? If you invest in this mutual fund, you own a piece of those companies. And as those companies grow over time, your investment grows over time. All right. This is a good mutual fund for people that are young, they're just starting their careers, and they have a lot of time to grow their investment portfolio. All right. If you're close to retirement, you could have some of this mutual fund in your portfolio, but you don't want to have 90% of your portfolio in stocks. All right. Generally, the older you get, the more bonds you want in your portfolio and the less stocks you want. All right. It's all based on your risk tolerance too. But if you're young and you have a huge time horizon, this is a great thing to look into. Check it out. Here's another example of a good mutual fund. This is the Fidelity US Bond Index Fund, and it tracks a bond index, as you can tell from the title. If you look on the right side, this is mostly tracking United States Treasuries, which are federal government short-term debt, Fannie Mae's, Ginnie Mae's, federal home loans. These are basically mortgage-backed securities that are backed by the federal government, all right? So this is it's not a 100% risk-free portfolio, but it's backed mostly by the federal government, which means this is probably not going to go down to zero unless the federal government defaults, okay? The reason I like this mutual fund is because there's $0 minimum to invest. You can start putting $1, $5, $10 a month into this, and you can start growing your portfolio and your assets, all right? The expense ratio, it's really low. Look at it, 0.025%. You're paying 3 cents a year, basically, for every $100 you have invested, and you get to own a piece of all of these bonds. It's a great deal. Now, don't listen to your scummy financial advisor. They're going to try to put you into loaded mutual funds, all right? I've talked about this plenty of times. It's not a good deal. You can buy these with no sales charges, and you pay next to nothing in fees, all right? It's a good deal. Now, you want to be in this mutual fund as you get closer to retirement. When you're young, you want to mostly be in stocks. So like the one I talked about previously, the S&P 500 mutual fund. You want to be in that pretty heavily when you're young. And then as you get closer to retirement, you want to start selling off that mutual fund and putting more and more of your money into bonds. This preserves the money that you've gained over time and helps you transition into retirement and protects your portfolio, all right? Let's say you want to buy some stocks overseas. Here you go, Fidelity Emerging Markets Index Fund. What does this invest in? Alibaba, Samsung, China Construction Bank Corporation, all sorts of huge companies that are overseas. So not only can you be exposed to the US stock market or the US bond market, but there's an index fund for international stocks too. And it also has $0 minimum to invest, and it has an extremely low expense ratio. It's all a great deal, and you can build a pretty diversified portfolio and pay next to nothing to do so. All right, everybody, if you like this video, you better like it, you better subscribe to my channel, and you better hit the bell button for notifications, all right? Now, before I close this out, I want to reiterate. I showed you 3 different index mutual funds, all right? Extremely low fees, $0 minimum to invest. So even a person that thinks they're poor can start investing in these mutual funds with next to nothing, all right? However, not every mutual fund is good for everybody. Everybody has a different time horizon. Everybody has a different risk tolerance. If you're close to retirement, you may want to be more in bonds. But if you have an extremely high risk tolerance and you want to take that risk, you can have a lot of stocks in your portfolio. Same thing goes for a young person. You don't have to be 100% into stocks. You can have some bonds in your portfolio. It all depends on you and your risk tolerance, okay? Hopefully that makes sense. So when you see these mutual funds that I showed you, you don't have to go and buy them right now, all right? You can look at other mutual funds. There's mutual funds offered by Charles Schwab. They also have $0 minimums. And you can weigh your different options and pick the mutual fund asset allocation that's best for you, all right? Hopefully that all makes sense. So hope you guys have a good day. I'll be posting another video tomorrow, and keep coming back. Later.